The year is 2025, and if you're paying attention, the echoes are getting louder. The same patterns, the same mistakes, the same blind confidence that preceded the greatest economic disaster in modern history are all around us. You can feel it. In prices that don't make sense, in headlines that sound too good to be true, in the quiet anxiety people carry when they swipe their cards and pray it goes through. Most people see rising stock markets and think prosperity. But the smart money sees something else entirely. They see 1929, all over again. When people think about the Great Depression, they imagine breadlines, dust storms, and broken men standing outside factories. But the real story isn't what happened after the crash. It's what led up to it. The Roaring Twenties weren't just about jazz, flappers, and champagne. They were about a financial fever. A bubble so massive, so intoxicating, that an entire nation convinced itself the party would never end. Sound familiar? Because it should. In 2025, we're living through the same delusion. Back then, everyone thought they had discovered a new economy. Now we say the same thing, just with better branding and faster Wi-Fi. Let me paint you a picture of America in 1928. The stock market had been climbing for nearly a decade. Everyone, from shoeshine boys to Wall Street tycoons, was playing the market. Credit flowed like water. People bought stocks on margin, betting borrowed money on dreams. The newspapers called it prosperity, politicians called it progress. Nobody called it what it really was: addiction. Today, different century, same story. Interest rates stayed near zero for more than a decade. Money was cheap, so cheap that entire industries grew out of thin air. Venture capitalists threw billions at companies with no profits, no plans, just buzzwords. Crypto turned speculation into religion. AI became the new radio, hyped, mythic, the future. And anyone who questioned it got laughed out of the room. In 1929, people said, the stock market has reached a permanently high plateau. Today, we say, tech will always go up. But gravity never forgets. Here is the part that should keep you awake at night. The wealth gap today is worse than it was in 1929. In the late 1920s, the top 1% owned around 23% of all wealth. Today, it's over 32%. Think about that. 1% of people own almost everything, while the rest try to stretch paychecks that vanish before rent is due. The rich can only buy so many yachts, so many houses, so many watches. Real growth comes when ordinary people, the delivery driver, the nurse, the teacher, have money to spend. But today, the middle class is drowning. Credit card balances hit record highs. Food prices don't fall even when inflation cools. People are taking second jobs just to stay afloat and still feel like they're sinking. In 1929, the average worker bought stocks on margin, putting down 10% and borrowing the rest. When prices fell, margin calls wiped them out overnight. Today, the leverage is different, but it's everywhere. Corporations are buried in debt. Governments are buried in debt. Consumers are buried in debt. Student loans, car loans, buy now, pay later. The whole system runs on the belief that tomorrow will always be richer than today. Sound familiar? It's the same blind faith that fueled 1929, and the experts back then said the same comforting things they do now. Don't worry, the fundamentals are strong. Politicians in tailored suits, central bankers with steady voices, all promising soft landings. But the truth is, they don't control the system anymore. They're JOS passengers pretending to steer. Meanwhile, billionaires are quietly moving their chips. They're buying farmland, building bunkers, converting cash into hard assets. Central banks, the same ones who call gold a barbarous relic, are buying more of it than at any time in modern history. You think that's coincidence? The irony is brutal. In 1929, most Americans still lived on farms or small towns. They had skills. They could fix things, grow food, survive when systems broke. Today, we live in glass towers and code-dependent cities. We can't fix a sink without YouTube. Our food comes in boxes we can't trace. Our money exists as numbers on screens that can vanish if confidence dies. When the crash comes this time, it won't just be financial. It'll be existential. Ask around. Small business owners are already feeling it. The bakery down the street pays triple for ingredients. but can't raise prices without losing customers. Truck drivers see fuel costs eat their profits. Young couples can't afford homes, not because there aren't enough houses, but because Wall Street owns them. Everyone's working harder, but somehow life feels poorer. That's not prosperity, that's the illusion of prosperity. And illusions always end the same way. Suddenly. Back in 1928, the newspapers were full of optimism. They said, "The American economy has entered a new era of permanent growth." Investors believed technology, radios, automobiles, airplanes, had rewritten the rules of value. Sound familiar? Today we do the same with AI, EVs, biotech, and digital coins. This time is different, they say. It's a new paradigm. But history has no patience for arrogance. In 1929, stocks didn't fall because someone shouted, "Crash." They fell because the math stopped working. Prices rose faster than profits, debt rose faster than wages, and confidence, that invisible glue, started to crack. Once it did, everything that depended on belief fell apart. Today the math is cracking again. Corporate earnings flatten while valuations soar. Government deficits explode while politicians smile for the camera. Ordinary people feel the squeeze, but are told it's all in their heads. It's not. When history rhymes, it doesn't whisper, it roars. And right now, the roar is getting hard to ignore. You can feel it when your rent jumps, but your pay doesn't. When your groceries cost more, but the inflation rate goes down. When your retirement account looks high on paper, but can't buy you real life security. That's the disconnect, the same one that existed in 1929. The market says, everything's fine. Your wallet says, no, it's not. And in between those two truths, that's where collapses are born. The experts will say it's temporary, the politicians will say it's under control, but remember, they said the same thing 96 years ago, right before the floor gave way. The system always looks strongest right before it breaks, and if you listen closely, the cracks are already talking. Gold doesn't lie. It whispers, quietly, patiently, when everything else is shouting, and lately it's been screaming through the charts. While everyone's watching stocks and crypto dance on a fragile stage, gold's been moving like it knows something the rest of the market doesn't. Something big, something ugly. See, leaked data from institutional reports and commodity desks, the kind that never make it to your TikTok feed, show an eerie pattern. Gold is rising for the wrong reason. Not out of optimism, not because economies are thriving, but because big money is scared. They're not chasing returns, they're running for cover. And if history's any guide, when gold runs before the herd does, it's not a rally. It's a warning. Now, before you shrug and think, oh, it's just another doom headline, let's rewind. Because this story, the relationship between gold and collapse, isn't just about charts or traders. It's about people. It's about your job, your rent, your grocery bill, and the eerie sense that the system isn't as solid as it pretends to be. You can't eat gold. But in every crisis, people suddenly remember its taste. The first time this whisper turned into a scream was 1971. Nixon slammed the gold window shut, ending the Bretton Woods era. Overnight, the world switched from money backed by gold to money backed by faith. And faith, my friend, doesn't hold up well when inflation starts eating dinner with you. By the late 70s, gold exploded 20x in price. Oil shocks, wage spirals, recession, people lined up for gasoline and small businesses folded because nobody could afford to borrow at 18% interest. The rich stored gold bars. The poor stored canned food. Then came the 2000s. Tech bubble, 9/11, cheap credit, rinse and repeat. Gold rose again, quietly at first, from $250 an ounce in 2001 to $1,900 by 2011. Why? Because behind the screens and statistics, ordinary people felt the same pattern returning. Inflated promises, corporate greed, and governments pretending the debt clock was just a background decoration. And here we are again. The leaked data, let us call it what it is, private liquidity flow reports and central bank purchase summaries, show something no mainstream outlet wants to discuss. Central banks have been hoarding gold at levels not seen since the Cold War. But it's who's buying that's scarier. Countries under dollar pressure, China, Russia, even small Southeast Asian economies, are diversifying away from the US dollar faster than ever. They're not just buying gold, they're building systems around it, quietly. And what about the West? Retail investors, that's you, me, the people who check prices on their phones while waiting for coffee, are rushing in after the institutions have already secured their vaults. It's the same playbook every time. The giants move in silence, and the public only hears the echo. But let's zoom in to where it hurts, the street level. Your neighbor, who runs a small cafe, just told you his coffee supplier raised prices again. The trucker delivering those beans is paying 20% more for diesel. Meanwhile, the bank just raised his loan payments because rates reflect inflation risk. You see what's happening? It's the gold signal, playing out in real life. It's not that people love gold, it's that they no longer trust paper. And when trust dies, that's when systems break. Think of 2008. Gold started its climb 2 years before the meltdown. Why? Because insiders could already see the rot, the subprime loans, the overleveraged banks, the fantasy valuations. But the average worker, they were told everything was contained. Sound familiar? Today's version isn't subprime mortgages, it's sovereign debt. Entire nations are borrowing to pay interest on previous debt. The global economy is like a credit card maxed out decades ago, now paying bills with another credit card. And gold, that silent witness, is rising, not in celebration, but in warning. Every empire that has fallen left behind the same trace, a trail of debased currency and a people who realized too late that paper wealth was a mirage. Spain had silver, Rome had denarii, America has dollars, and every one of them, in their final days, saw gold move like a compass needle pointing to collapse. You don't need a Bloomberg terminal to see it. You can feel it at the gas station, at the grocery store, in the uneasy silence when your boss says, "We're restructuring." And here's the kicker. This isn't panic, it's pattern. Whenever governments print to patch a hole, inflation lags. When inflation rises, rates follow. When rates rise, credit tightens. When credit tightens, markets break. And when markets break, the same safe haven cycle repeats. Gold goes parabolic, but not out of joy, out of fear. It is easy to mock gold bugs, those old guys ranting about fiat money and sound money. But history keeps proving them right, at least once a generation. Because while memes and tech stocks fade, one thing doesn't change. When everything burns, people still reach for the only thing that doesn't. Now, let's be honest. Maybe this time it's different. Maybe inflation cools, AI saves productivity, and rates normalize. Maybe. But the numbers don't agree. The leaks show liquidity drying up, central banks holding more gold than dollars, and emerging economies cutting side deals to trade in local currencies. That's not confidence, that's exit planning. So what happens next? If the 80-year cycle holds from 1944 to now, we're due for another reset. Not a crash you can trade, but a rewrite of the entire game. And gold is the draft before the script. You can laugh it off, or you can listen. Because every time gold starts screaming, history starts rhyming. And when it does, the melody always ends with the same note. You were warned. When systems crack, they never do it all at once. It starts as a whisper, a missed payment here, a quiet bankruptcy there. And then suddenly, it's everywhere. By mid-2026, those leaks we talked about, they're no longer leaks. They're floodgates. The yield curve that flashed red in 2025 wasn't just a number. It was a countdown clock. Corporate debt defaults are spiking. Small businesses, the ones that made it through the pandemic, are now being crushed under higher loan renewals. The cafe owner who used to complain about milk prices now faces a landlord who wants double the rent because everyone's rates are up. And gold? It's broken through $2,800 an ounce. Headlines call it a safe haven surge, but you and I know better. It's not rising because of growth. It's rising because trust is dying. See, this isn't just a market correction. It's a faith correction. The belief that governments can print without consequence, that tech will save us from cycles, that the Fed's got our back, all of that is collapsing under its own weight. Remember 2008? People lost homes. This time they'll lose confidence. In every major downturn, gold becomes the mirror. And what it's reflecting right now is fear disguised as policy. Governments announce stability measures. Central banks say temporary volatility. And yet, quietly, they were doing the same thing every fallen empire did. Debasing their own currency to buy time. They don't call it that, of course. They call it quantitative flexibility, liquidity management, or stimulus. But at street level, it looks like this. Your paycheck doesn't stretch as far. Your savings earn less than inflation. Your landlord raises rent to keep up with costs. And you start wondering if maybe that old guy buying gold coins at the pawn shop wasn't so crazy after all. That's how collapse really feels. Not like fire, but like slow suffocation. Look at history. Spain, 1600s. They drowned in silver from the New World, mountains of treasure. But prices soared, wages stagnated, and their empire rotted from within. Gold didn't save them, discipline did, and they lost it. Fast forward, the US, 2020s. Massive stimulus, record debt, speculative bubbles. The numbers change, but the rhythm doesn't. Money loses meaning, and gold reclaims it. And here's the irony. Every generation thinks they're smarter than the last. They say, it can't happen here. Rome said that too. So did London in the 1920s, New York in 2007, and maybe you, right now, scrolling this video thinking, I'll be fine. But ask yourself, how many friends do you know could handle losing their job for 6 months? How many businesses could survive one more rate hike? How many governments could pay their debt if rates stayed high another year? That's not resilience. That's fragility wrapped in denial. And gold, that dumb yellow metal everyone mocks, is the one thing that never believes the lie. By the second half of 2026, the pressure's global. The dollar's dominance is questioned. Emerging markets are trading oil in yuan. Nations that used to stockpile treasuries are now trading them for bullion. The financial elite call it portfolio diversification. But history has another name for it, preparation. The meltdown isn't a crash you see on a chart. It's a slow-motion reset you feel in your wallet. A young couple delaying kids because childcare is unaffordable. A truck driver sleeping in his rig to save fuel money. A retired teacher realizing her pension payout buys half what it did 5 years ago. That's what the data doesn't show. The human inflation. And when people lose trust in money, they start bartering trust itself. That's when the system rewrites itself. Every great reset, from Rome's Solidus to Bretton Woods, ends the same way. The strong rebuild with systems, not treasure. The weak cling to what glittered and fade. Maybe that's the real secret the gold charts are whispering. The problem isn't inflation, it's fragility. Because wealth isn't what you own, it is what survives when the market forgets you exist. The lesson? Spain measured wealth in silver, Britain in colonies, America in credit. The next superpower, whoever it is, will measure wealth in systems that don't break when faith does. And for you, the worker, the small business, the saver, the real hedge isn't gold or crypto, it's clarity, knowing that money, like power, always flows toward trust. And when that trust dies, those who saw it coming don't panic, they pivot. So yeah, the data looks bad, gold's screaming, currencies are trembling. But the real story isn't that the market's collapsing. It's that we're being invited, again, to learn what real value means. History doesn't repeat, but it loves reruns. In 1929, people thought the stock market was too big to fail. In 2008, banks were too smart to fail. In 2026, we'll find out whether people are too proud to listen. If this story made you think differently about gold, about money, about how fragile this all really is, hit subscribe because history's talking again. And I'll show you where to listen.